Thank you for joining us this evening. We're pleased to have each and every one of you on a Tuesday night. It's supper time, and you've made time out of your busy schedule to join us. So thank you for that. I'm joined by my business partner, Chip Wilcox, and Chip is, I tell you, it's really nice to have you on this evening with me here. I've done a lot of these with me and Kimberly and a guest, and having you in the room is a huge help. We banter back and forth different investment ideas all the time. Chip is constantly researching, constantly studying his investment models for his clients and for our clients as a firm. And we certainly appreciate his insight. So welcome, Chip.
Thank you, Matt. Pleasure to be here.
Of course, Kimberly Stone is our client relationship manager, and she takes care of so much at our firm. But she's put together this whole webinar for us this evening, and she's going to be helping us later on with questions and answers. So Kimberly, I believe, is muted, but I know that I want to just shout out to her and say thank you for all her hard work. And then we're very pleased to have with us this evening Nicholas Johnson, which he prefers Nick, so we're going to call him Nick. Nick, thank you for joining us. You represent JP Morgan Asset Management, and I know a lot of folks have heard about JP Morgan. Wonderful firm, great partnership over the years, and we appreciate the relationship we have with you guys. Every time I've ever got an invitation from Nick to hear you speak, I've tried to attend. So it's always informative. It's always helpful. So we're excited to hear from your perspective and from your firm's perspective this evening. I went ahead and shared my screen, and so that's been taken care of. And I'm going to go ahead and switch over here to my slides so that I can. All right. And so again, Nick, you're not too far away, right? You're in Greensboro this evening. Is that right?
That is correct. I hail from Charlotte, but I am in Greensboro tonight, staying at the lovely O. Henry Hotel. So life is good.
Yeah,
thanks for having me on.
And I believe you have two children, right? It's what I read. You've got a 10-year-old and a 2-year-old, correct?
That's exactly right. Boy and a girl. We that was not on purpose for there to be an 8-year difference between the two, but sometimes it just happens that way. And we've got 2 9-week puppies at home as well. So that's why I'm in a hotel tonight. It's
Oh, that sounds good. So that's actually pretty good planning, because you can get you're going to go all the way through grad school, I'm sure. So you can get one finished and then start on the next one.
That's what we were thinking. Yep.
Yeah. Well, I'm going to go ahead and just mention a few housekeeping things. Tonight's agenda is pretty simple. We're going to have some opening remarks, which we're doing right now, and then JP Morgan's mid-year outlook 2024. So we're excited to hear from you guys on your outlook. And then we're going to have, in the second part of our evening, we're going to have some time to talk about some actionable insights from Cannon Wealth Management. So, and I'm looking forward to sharing a few things that we've been looking at, we've been studying on, that we think investors should know about, and hopefully you'll find that helpful. And then we'll wrap up this evening with some Q&A. The agenda says we'll be going for an hour. We rarely go that long, so we'll try to keep it short so you can get on about your evening. Thank you again for joining us. The most important people on tonight are our attendees, those who not only are clients, but also those who are interested in potentially becoming clients. We appreciate you joining us. And then just our friends and folks out there who want to learn. And so we hope you find this helpful. If you do find this material helpful, please let us know. Let us know how we can improve beyond making sure we click the button on the microphone. And we will certainly try to do that. And then also, of course, we invite you to share this information with your friends and family. If you'll reach out to us, we can get you a link, and you can share that link with other folks that you might think this would be helpful for. So, but without further ado, I'll go ahead and dive into our slides this evening. And Nick, if you would, take it away.
Great. So just by way of an intro, you're in really good hands with the Cannon Wealth Group. I'm going to do my best to try to get this done in an appropriate time. I just did it earlier today, and it took me about 45 minutes. So I'm going to talk fast, all right? And I'll try to skip some stuff that is not maybe as relevant, but I'll start here, all right? Not with this chart necessarily. And you'll get a copy of these charts if you would like them. If they put you to sleep, we'll still send them, and it's good for insomnia and stuff like that, all right? But these are accessible to you. I'll start with a quote. When asked, what was the best asset a man could have, a guy by the name of Albert Lasker, who was like the most astute of all advertising men, said, humility in the presence of a good idea. And it's horribly difficult to recognize a good idea. So the purpose here is not to tell you what's going to happen and how you should invest, because just nobody knows. All right. And here's the thing, like, we don't have to know or try to predict the future. Rather, we just need to see the present with clarity and the past with perspective, and try to do it with humility. And that's all we need to be good investors. And that's what we'll attempt to do tonight. So thanks for joining us. Everyone is sort of like shrugging their arms in the air, or whatever you'd like to call that. Nobody seems to know what to do here. The S&P is at an all-time high. It's up 26% over the last 12 months. I know everybody loves cash right now, paying you 5%. I like 26% a whole lot better. And yet volatility in the markets is still below 10%, which means investors are rather complacent. And you've had some short-lived European political drama. You may have had a presidential assassination attempt over this past weekend, and I'm not making light of that. And yet markets just keep marching higher. And so if we were to speculate, which I just told you we're not going to do, I would tell you volatility, I think, is coming back. All right, maybe not now, but at least after Labor Day. Our economy's been slowing down a bit. If you really want to get the economy moving at some point, you're going to have to reset something. Either the Fed needs to cut rates, equities need to do something. Perhaps it's a minor little sell-off. People are going to take 5% all day, even though I just told you missed out on a 26% return over the past 12 months in stocks. And you're going to have to reset people's expectations around what is actually happening in the economy. Are we headed towards a recession, or are things great? All right. And you're not getting any of that reality from the news media, I'll be honest with you. And right now we're just in limbo where none of these things have been decided. So if we're looking at this chart right here in front of us on the economy, at the beginning of last year in 2023, Bloomberg, so-called experts were saying 100% chance we will have a recession by the end of 2023. Don't ever believe anybody that tells you there's a 100% chance of anything happening. Here we are halfway through 2024, and it doesn't appear that we're in one. Maybe they'll tell us next year that it started in 2024. I don't know. You can see here very faintly year over year and quarter over quarter growth for the economy. They're all in positive territory. Not sure where second quarter U.S. economic growth will come in, but I think it'll have a 1 to 2% handle on it. So that's not a recession. First of all, economic cycles are very natural and needed. We are always worried about recessions. But right now we are suppressing economic cycles. And by that, I mean the Federal Reserve, and then more recently, the U.S. government through fiscal policy. We are injecting, an artificial equilibrium to keep this economy moving, which is great in the short term. All right. But it can make things a little bit more fragile over the long run. And we just need to be prepared for that. It's almost like we're not allowed to have a recession anymore. We need recessions. It's like plants need winter. You need lower temperatures and shorter days, to become dormant, so that plants can save up enough energy for new growth, right? Like if a fruit tree doesn't have enough chilling time, it produces fewer buds. So recessions are healthy in this economy, and our Fed and our government just doesn't want to see them happen anymore for lots of different reasons. Now, second, we do see a lot of signs that growth is slowing in the U.S., but it's remained just remarkably resilient. And our economic system, I think, has become much more stable. We spend a lot less time in recessionary conditions. Why? And I think there's three big reasons. The first is just geopolitical stability. All right. It's not rocket science, but by having less systemically important wars, you're going to have way more financial and economic stability. Now, you're going to say Russia, Ukraine, and the instability in the Middle East. Yeah, that's going to have an impact on food prices and things like oil. But for the most part, geopolitical events have had very, very little impact on markets over the last 50 years. And I think that trend continues. Also, we have had a shift from a gold standard back in the 70s and beyond to a fully elastic fiat money system. The gold standard worked by pegging our currency, not backed by anything, to a fixed hard asset, which was gold. All right. And that reduces the odds of rapidly expanding or devaluing your money over time. The flip side of the gold standard was the government just can't print and expand money creation when they need to stabilize the economy during things like a pandemic or a recession. And so after the 1970s, or during the 1970s and Nixon's presidency, we migrated towards a fully elastic fiat money system not based on gold. What does that mean? It means that policymakers can now try hard to cancel the concept of recessions. They can expand money, create money in a fully elastic way, which sounds great, but as you can imagine, and this might be hard to believe, politicians can sometimes abuse the system. And this leads to where we are today, where policymakers are trying really hard to stay in office, erase the concept of a recession altogether. But in a capitalistic system, this doesn't always work, all right? Recession should be a part of the standard economic system. We don't always need to get bailed out by fiscal policy or the Fed. Let a recession happen. It's good, it's a cleanse, and we can restart the economy ever stronger. So regardless of what happens here, don't be afraid of recession. It's natural, it's well needed to bring about new growth and healthier growth. Are we going to have a recession? I have absolutely no idea. I'm done trying to pontificate on this. But here's just a small example. Something as boring as like container freight rates, all right, are actually rising. At the peak of COVID, it cost about $16,000 to transport a 40-foot container from Shanghai to New York. And then it dropped back to its historic average, which is like $2,000 to $4,000. Now it's back up to $9,000 to transport a container from Shanghai to New York. Here's the thing. If the global economy was slowing down rapidly, all transportation costs would be falling and plummeting, and that's not what you're seeing right now. So that tells us, just one minor example, that global growth continues to be fine. Now, eventually, higher interest rates, which we've seen since March of 22, when they started raising rates, it is eventually going to create a drag on the economy. All right, lower interest rates, that creates more investment. It reduces the hurdle. I'm sorry, with higher interest rates, it kind of reduces the hurdle to take risk, and higher interest rates can ultimately create headwinds to investment, but that is not happening so far, and it's not happening as quickly as I think the Fed had envisioned it to happen. So moving on to the next chart, which looks at inflation, the Fed was forced to start raising interest rates in March of 2022 when inflation was almost 10%, as you can see from this chart, highest in over 40 years since the 70s. We got good news last week. Year-over-year inflation was lower than expected. Inflation was predicted to come in at 3.1 year over year, and it was only 3%. Now, that's good news. It's better than it going from 3.1 to 3.2, but we're talking about like 1/10 of 1%. Like, who cares? I think people in the markets get a little too excited reading into these prints when these are not huge changes in numbers. And I do think once the inflation rate starts with a 2 handle, psychologically, I think that's going to be a big change for people and markets. There is a negative or bearish take on the lower inflation number, which has been just super positive for markets so far. So the cooler U.S. inflation number was positive, but the present market conversation is focused entirely on the virtues of monetary easing, the Fed being able to lower interest rates, and we're not factoring in the downsides. What are the downsides? Cooler economic growth and waning corporate pricing power. So the issue of reducing pricing power has been on full display with recent earnings. So think about food brands like Conagra. They make Slim Jims and ketchup, all right? Or airlines like Delta, companies like Pepsi. Now, that's great news for us as consumers. Those prices should come down. But as investors, what is this going to do to the earnings of those companies that we're investing in, right? And that's why we need managers to be taking this into account and doing correct research. More important, I think, is what is the long-term outlook for inflation? The last big crisis outside of the pandemic, which, was something unprecedented, was in 2007, 2008. All right, the housing market cracked under the pressure of excessive private sector leverage. All right, and when private sector credit rises uncontrollably, you get a credit event, or in essence, something breaks. And that's what we saw, a U.S. housing bubble. We're seeing that today in China and their real estate market. Today, the story is completely different. The private sector in the U.S. has actually been deleveraging since 2008. Instead, today it's all government deficits. All right. The scale of government deficits in 2020, 2021, between two administrations was absolutely enormous for COVID. And driving money creation that's still circulating in the economy. We got another fiscal shot in 2023 when small banks started to have some trouble. And that means the risk this time isn't necessarily that something breaks, especially in the U.S. The risk this time is the government keeps throwing fuel on the fire, and it might end up reaccelerating inflation, which makes, I think, macro cycles more volatile. And in that environment, I hate to say it, but cash and cash equivalents is the worst place you can probably invest, because inflation just cannibalizes most of that yield that you can earn on savings. All right. If we go to the next page, in the short run, how are we thinking about markets? I would say, right now the S&P is probably short term a little bit overheated. Long term, it's absolutely a place that we want to be invested in. The S&P is up almost 19% year to date, 26% over the last 12 months. Investors are chasing stocks on the back of what I think is recycled news, which is the Fed is going to cut interest rates. There's a 90% chance they cut rates in September 18th to be exact. And what we're seeing in the last week is, the equally weighted S&P, call it the 493 stocks outside of NVIDIA, Google, Apple, Meta, Tesla, Microsoft, they're starting to do a lot better. Small cap stocks are actually closing the performance gap further versus the S&P and growth stocks in the NASDAQ. On the left-hand side, the lower that gray line is, the cheaper value is relative to growth stocks, okay? So if anything, we want to be shifting a little money and taking profits from some of these big mega cap tech companies and moving them towards area of the markets that haven't done so well over the last couple of years. But I think equities are focusing a lot on these macro virtues, monetary easing, this Goldilocks data, which is not too hot, not too cold, very healthy earnings, the reduced risk of tax hikes, deregulation. And I don't think we're paying much attention to some of the downside risks, which we are seeing softening growth. We're seeing disinflation that is only occurring modestly. Again, we went from 3.1 to 3. It's not like we went from 3.1 to 2. And then we've got these astronomical deficits and exploding debt at a time when valuations or prices for stocks are pretty darn elevated. So we need to keep that in mind and not throw all our chips in on 5 or 6 mega cap tech companies, right? We want to be really diversified in this market. Shifting to politics, I know this is everybody's favorite topic. I'll pause here if we can go around the room or around the Zoom and just who is everybody voting for and why? I'm kidding. You're on mute anyway. You can't do that. But look, this was supposed to be a week dominated by the Republican convention, which kicked off last night, renominating former President Trump. He picked, as we know, J.D. Vance from Ohio. Why did he pick Vance? Probably, his loyalty to Trump, which is a big thing to Trump. He's a very good communicator, his political calculations. I think Trump feels that Vance will help him in PA and Michigan. For Democrats, it's this tightrope to walk where they've got to conduct their campaign in August, deal with the emergence of a full Republican ticket, and then respect a leader somehow who survived an assassination attempt, which, is tricky to do when you're trying to attack said leader, right? And obviously a great deal of angst over the cognitive decline of the Democratic candidate. Biden is continuing to defend his mental acuity and stamina. Right now, at this point, he's insisting he is not leaving the race. I think you'll try to see the DNC confirm Biden as the party's nominee by the end of July. But we'll see. All right, love it or hate it, both of these parties are going to continue to run giant unsustainable deficits, one through big spending programs, which you may agree or disagree with, the other through tax cuts. But I want to focus your attention on what's really important here, which is the bottom of the page. I don't care what administration, Obama, Trump, Biden, look at what the market did during those regimes, up 16.3% annualized across Obama's 8 years, 16% across Trump, 12.4% across the 4 years with Biden. So I don't care what your affiliation, the market has worked. And if you look at the top part, it just shows you like how we feel about the economy is usually determined by whether our candidate or our party is in office. And I'm going to tell you this, do not let your political emotions impact your investment decisions. It has not ever been a wise decision to do. So regardless of who wins, whether it's your candidate or not, don't get overconfident. Also, don't panic and think that the sky is falling and you need to go to all cash. Big picture on the next chart, it's all about debt, all right? And when there's as much money in politics as there is, it's really in nobody's interest to be a realist. And I hate to say that, but we're looking at federal finances, what we spend versus what we take in on the left-hand side. The Congressional Budget Office came out with a piece 2 weeks ago. They are modeling in 7% deficits. You can see the deficits at the top right part of the chart. 7% deficits, that is World War II-like spending. And I don't think we're in World War III right now. Never going below 6% deficits for the next 10 years, no recessions the entire time, and we're going to see almost 2% of Fed fund rate cuts over that time frame. So the Fed funds rate would come from around 5.25 down to call it 3.25. And unemployment never goes above 4.5%. Now, I think the result of this is higher rates of inflation for sustained periods of time. And we haven't had to deal with an investing environment like that since the 70s. Do I want to sell out of my stock positions on that? Absolutely not. I want to be thoughtful about maybe hedging them. I want to think about ways to generate income from those equity or stock positions. I want to find more thoughtful ways to invest in bonds. I don't think we can just invest in the JP Morgan Core Bond Fund, which for the last 40 years has been a beautiful way to hedge equities. I think we're going to have to be much more thoughtful around including some bond alternatives and also some equity alternatives. Maybe we start buying some hard assets, real estate, gold as a complement to our stocks and bonds. But here's the bottom line, all right? We are shelling out $3.3 trillion in entitlements to retirees, all right? They're getting that every year. That's not going anywhere. Defense is about $900 billion, about 4% of our economy. That's only going to go up with all the geopolitical conflicts around the world. And then lastly, our interest, which you can see, which is that purple box, I believe, that is gone from $640 billion. That's the interest we're paying on just our debt. $640 billion to by the end of this year, we're going to be paying $1.2 trillion on our debt. There's only one of those three things that is going to go down, and it's going to be the interest we pay on our debt. How do you do that? You have to eventually lower interest rates. The Fed has to do that. So the Fed will eventually cut rates, and they're going to have to do it. They can't afford to be spending $1.3 trillion just to service our debt. I think that's going to be stimulative unless we're in a recession, all right? And so if they cut rates, I think it's a good chance that stocks go up. And it's hard to see a recession in that environment. What people are not paying attention to is the public sector. We always pay attention to the private sector. We need to pay attention to the public sector here. The U.S. is spending almost 25% of U.S. GDP. They're basically, creating 5% of economic growth by themselves. All right. Now that has ramifications, which I just told you, inflation. But, the other 75, 76% would have to be falling at almost like 7% just to have like flat economic growth. And that's just not happening. In 2008, economic growth fell 3%. So basically, you need a private sector to do 2 times worse than it did in 2008 in order to have a significant recession. Can that happen? Maybe. Is it happening right now? Absolutely not. Can that change with election? Sure, but it seems unlikely for both of these candidates in 2024. So what does that mean for bonds and a 10-year treasury? We go to the next page. On one side of the coin, I think there's sources of supply and demand. So this is just looking at our yield curve. The dark blue line is showing you we have an inverted yield curve, meaning the short end, the 2-year treasury is paying you more than something like a 10-year treasury, which isn't supposed to happen. You're supposed to get paid more to give the government your money for a longer duration. Treasury issuance doesn't show any sign of slowing down. I just talked about deficits. And yet demand has been pretty negative for the past 2 or 3 years. So if the Federal Reserve isn't buying these treasuries, which I think they're going to have to do, commercial banks are still under pressure from all the turmoil we saw last year. Then you got to rely on foreign buyers to buy our debt, and they don't seem to want to be buying as much. So for us, I think it's really difficult to see either the front end of this yield curve or kind of the longer end of treasuries falling very quickly from here. If anything, I think you want to be in the shorter end of the curve. That's what I think will fall in line, right in line, directly correlated with Fed funds rates, which I told you I think are going to need to be cut. You're making more to be in that area anyway. You have less interest rate risk, and that's an area where you can pick up a couple % of price appreciation plus a yield above 5.5%. It wouldn't be a surprise to us to think that you could make 6.5, 7% sitting in like an ultra short bond fund with very little risk, one step out of a CD or a money market over the next, call it 12 to 18 months. I will take that all day and put it into a portfolio. And that then gives you optionality where you're making a lot to sit and wait for any kind of dislocations in the market. One thing, that I think we need to pay attention to is there's two possible paths from here if we go to the next chart. If we continue to get inflation, what we need to see is financial conditions need to tighten. What does that mean? We need to see, slightly higher interest rates. We need to see declining job openings. We need to see declining quit rates, meaning people aren't quitting their jobs and going to another job next door because they can make more money. We need to see declining temporary workers. That sounds terrible. I don't wish anybody to lose their job, but we have to see some fringe weakness in labor markets. And if that happens, inflation can cool, and then the Fed can cut in the second half of this year. Now, right now, this chart shows you unemployment, the gray bar. Unemployment went from 3.6% up to 4.1%. So we're already starting to see that fringe weakness, all right? And here's the important thing. This is the kind of Fed cut that is sustainable and can still lead to a continuation of a soft landing. Right now, if the Fed cuts interest rates with financial conditions really loose because rates are down, equities are sky high, what happens to stocks? They go to the moon. And what happens to inflation? It reaccelerates, and we're back in the same position we were in a year and a half ago, where a Fed has got to fight inflation and bring that down in order to stabilize the economy. All right, so the Fed needs to cut because the current tightness of policy is restraining to the economy, all right, in such a way that the economy needs a cut. And we're not there yet. The markets think we'll be there by September. I'm skeptical of that, but I do think the Fed by the end of this year will at least cut rates one time. You can go to the next page to see the Fed funds rate chart. The gray bar is where the Fed funds have rates now. The green and the blue are what the Fed is telling us they're going to do with rates. The green is what the futures market is telling us they're going to do. And you can see a lot of significant cuts. The purple diamond is ultimately where the Fed wants the Fed funds rate to be ultimately, which is around 2.8%, a little more than half of where it is right now. The problem is that nobody wants to acknowledge if financial conditions do not tighten, meaning stocks continue to soar, which all of us want. Say the Treasury is spending down all the tax revenue that they just received in April, which puts money directly back into the market. Asset prices go up, things don't tighten. Inflation doesn't cool, it remains hot, it might even accelerate. And that's a situation in which the Fed cannot cut. It might even have to hike. That's not a good environment for, I would say, stocks or even fixed income in that environment. Maybe a 20% probability that happens. That's not how we're positioned, but you want some things in the portfolio that can work in that environment, all right? If we go to the next chart, just very quickly on positioning for that environment within fixed income, you can see all the yields on the left-hand side of the page. I know this is a wonky page, but look at the right-hand side, all right? We show you the impact of different components of the fixed income market if interest rates go up 1%, go down 1% in blue, versus the impact of the price if they go up 1%, which is in gray. Look at a 2-year Treasury. All right, interest rates go down 1%, you're making over 6%. If they go up 1%, you're still almost making 3% versus a 10-year Treasury, which would be, more in line with, say, like a core bond type investment. Interest rates go down 1%, which will happen in a recession. You're going to make double digits from that investment. However, if interest rates back up a little bit, which I think they could, you're going to lose about 3%. So I'm not telling you not to own something like a JP Morgan core bond or a total return bond fund from somewhere else. But I think the low-hanging fruit is on the short end, the 2-year and ultra short side of the curve, where it doesn't really matter what interest rates do. You're going to make some good money. And again, if interest rates go down, you're going to be in a really, really good place. So you're being paid well to preserve optionality, be very defensive in bonds, use some unconstrained strategies that can be very tactical and not just set in a static allocation. And then when it relates to equities, and I'll try to wrap this up here in the next 5 to 7 minutes, the next page just shows you what we already know, which are stocks are at all-time highs. And you can see on the left-hand side that, we've had, I don't know, 7% of the time stocks tend to remain or tend to be at all-time highs. But then on the right-hand side, we show you investing at all-time highs and basically what your cumulative return would have been, 1 year, 3 year, 5 years after investing at an all-time high, which is in green, versus investing at any other time when the market is not at an all-time high. And this was shocking to me, but look, 1 year, 3 year, 5 year, you actually made more money investing at an all-time high than you did investing any other time in the market when the market was not at an all-time high. And this doesn't seem like it makes a lot of sense, but think about it. When the market is at an all-time high, there is a ton of momentum and tailwinds that are pushing that market higher and higher. So do not let your excuse to not invest in stocks at this moment be that, hey, we're at an all-time high, I'll wait till this market pulls back. This market might go up another 10 to 15% before we get a pullback. And at that point in time, again, you've missed out on that return. I'm not saying the market's going to do that. I think we're overdue for a bit of a correction, but don't sit on the sideline waiting for that to happen. If anything, at the very least, be dollar cost averaging into this market if you haven't already. The next slide I think is very important. All right. Top right-hand corner, you've got 10 stocks that make up almost 40% of the S&P 500. Four stocks have contributed 50% of the return of the all-country world index, not the US, the all-country world index. 4 stocks: NVIDIA, Microsoft, Apple, and Eli Lilly. You have to be in portfolios where you'll be invested in these companies. However, you have to be also invested in areas where these 4 stocks, these 10 stocks, which command an enormous market cap in the stock market right now, if they go south, are not going to totally ruin your investment. So we would be taking gains from some of these magnificent 7 mega cap tech stocks and moving them into areas like value or even small caps, which have not performed nearly as well as their mega cap partners. A big reason why, these 10 tech stocks make up 40% of the market is on the next page, which is we're currently in an AI revolution. All right. And when momentum is on your side, people will focus on your strengths and they'll forgive your weaknesses. And that is exactly what's happening with NVIDIA and Microsoft and Meta. But when momentum stops, they scrutinize the entire thing. All right. And we saw that happen in the late 90s, early 2000s with some of these companies. That's something that we could eventually see. So we want to be diversified outside of these mega cap tech companies, but you have to own them. All right. Now, is there a bubble in AI or tech? I think that's going a little too far. We personally think the artificial intelligence wave is real. The question we're asking is whether the level of investment that we're seeing going into something like cloud service infrastructure, which I know gets wonky, is that sustainable? So the left side of this chart just shows you capital expenditures from the major AI hyperscalers. What in the heck is a hyperscaler? It's just a large cloud service provider. They provide computing and storage at enterprise scale. So that's Microsoft, Meta, Amazon, Oracle, Alphabet. That's a huge build out happening right now. Billions and billions of dollars are going into these new cloud service centers. Is this sustainable? All right. You can't spend this kind of money and show no incremental revenue potential. So this is incredible for NVIDIA, but the chicken is coming home to roost, because if you don't start seeing revenue flow to the bottom line of these companies that are spending $26 billion a quarter, the market cap of NVIDIA is not what the market cap of NVIDIA should be. And all these other companies that are floating higher because of NVIDIA are going to get punished for spending this kind of money. So where all these newfangled things that we're supposed to see justifies, $100 billion of chip spending a year, like where are they? We need to see them. All right. And that hasn't quite come to fruition yet. The bottom line on AI, I think we need to think back to, kind of the late 90s. All right. Where you had telecom companies that supposedly wasted billions of dollars investing in all this broadband infrastructure. And then we had the dot-com crash. And everybody thought they were wrong to invest billions in broadband infrastructure. It just took a while for that stuff to get used. And that's a pretty common pattern with technological revolutions. You might have a short pullback or a bubble in the short time. Think about Amazon in the 90s. If you owned Amazon, you got crushed for a while. If you held on to it, it's worth an absolute fortune right now, right? And I think you're going to see that with some of these AI mega cap tech companies, or even some of the smaller companies. So it'll get justified in the mid to long run, but maybe not right away. Think about something simple like railroads in the United States. We had huge railroad bubbles, but it turns out the investment in railroads was pretty darn worthwhile, right? And I think you're going to see that with AI. So you want to own a bunch of these tech companies. You want to own smaller companies that are going to be the next Microsofts and NVIDIA. So own all cap equity portfolios, which is easy to do and efficient and cheap. However, have some stuff that is not at all related to AI and tech. All right. I think that's very important. And the team can talk more about this. Equities over the short term, I just think you need to be active at these valuations. On the next page, you'll see the stock market valuation. I'm sorry, I'm going fast here. I'm trying to wrap up. Is not cheap. Far right-hand corner, we're trading at like 21.5 times earnings. The average valuation for the stock market is that dotted green line in the middle, which is like 6.5 times forward-looking earnings. Don't worry about what that necessarily means. Just means the stock market is a little frothy and a little expensive. This doesn't mean the stock market comes down. It just probably means your return expectations probably need to come in a little bit. So the average retail investor thinks the stock market will do 12.5% annually over the next decade. Why? Because that's what it's done over the last decade. The average institutional investor thinks the stock market will do 7% annually over the next decade. I'll take 7% all day long. That's great. You'll double your money in a decade. History would suggest starting at these valuations, it's more likely you probably do like 4 to 5% annually in stocks over the next decade. Now, a lot can change. Productivity, this AI revolution, earnings could be robust because of, what I just mentioned. So no guarantee in all of this. All I'm telling you is find active managers that can get you excess returns after fees. If the market's only going to give you 5, which I hope it gives you a lot more than that, if you can find a manager who after fees can give you 1, 2, 3% higher than that, that's going to make all the difference in the world. If we can put some hedges in the portfolio, implicit or explicit, that is going to help you to where when this market, or if this market ever pulls back, you're not being impacted as much. And that's going to, allow you to not need to make up as much, right? So consider that. And then, lastly, I'll just say, don't be levered up in this market. You don't need to take a ton of risk. Have equity in just really, really good companies. The team can help you with that. We've got really good research platforms across a bunch of different asset managers. I think I work for a good one that can help you pick those companies. I think you can sock a ton of cash at the short end of the yield curve because the government's paying you 5.25% to do that. So take advantage of it. I wouldn't be rolling 6-month CDs because there's no guarantee you're going to get 5% from a CD in 6 months from now if the Fed's going to cut rates. Get it while you can on the short end of the curve in an ultra short income fund or a limited or short duration strategy. I think it makes a lot more sense. And then don't be too over aggressive in fixed income. I don't think you need to own 30-year treasuries because no idea what interest rates are going to do. I don't think you need to own a lot of treasuries to begin with because of what's going on with our debt in this country. I don't think you need to own a ton of high yield. It's not getting you enough of a return above, say, a high quality asset to make it worth the risk. Just be defensive in fixed income, have some implicit and explicit, hedges in the equity portfolio, and stay invested. There's going to be volatility, but be a long-term investor. Don't let your emotions get you down. And last thing, long-term investing is about being able to absorb manageable damage. We all get caught up in this comparison game. We're comparing benchmarks. We're comparing ourselves to our neighbors and the money they've made. Don't do any of that. All right. The trick here is not to avoid short-term volatility. It's to minimize it. All right. You will create a durable portfolio when you can survive volatility. All right. It's going to happen. It always happens. It happens every year. We haven't seen it for the last year and a half, but I guarantee you it's coming. Don't be alarmed when it does come. It's natural. It's a way to reposition assets when it does happen, and just stick to the longer term plan, which you'll have in place, through Cannon Wealth, and you're going to be in good place 3, 5, 10 years outside of this. So sorry I went a little bit longer than expected, but I'll turn it back over to the group. Happy to answer any questions, but I think they've got some remarks as well.
Well, thank you so much, Nick. I thought you did a great job. That was a lot of information to cover, and I'm sure we'll have questions. I'll be checking here in just a moment to see if anybody has posted any questions in Zoom. I don't think I mentioned it before, but if you have trouble posting your question there in Zoom, feel free to email that to us at info@cannon-wealth.com, info@cannon-wealth.com, and Kimberly will either get those to us during the webinar, or possibly if we can't get to them during the webinar, we'll get to them later, and we'll be sure to respond to you just as soon as we possibly can. But great information. Thank you so much. Very informative. This brings us to the second part of our presentation, where we will discuss some actionable insights and potential opportunities for investors. I'd like to ask Chip to share. I know you have some comments you prepared for just talking about how we manage money and how we work with different money managers in our firm.
Yeah, thank you, Matt. I appreciate it. And Nick, thanks so much for the information. We appreciate JP Morgan. JP Morgan is one of our trusted partners, and at Cannon Wealth, we do our very best to screen the managers that we use, and we try to take a rigorous approach to that. And JP Morgan Asset Management has earned a place in our portfolio. So thank you so much for that, and for the insights that JP Morgan has. And when we take these comments and information and all of the data that is presented to us by our trusted partners like JP Morgan and our other trusted partners, part of our responsibility is just to bring it back down to the client level and look at what does this mean to you as a client for your portfolio. And we know that what's most important is that we take into consideration a client's time horizon, goals and objectives, the amount of risk they're willing to take, and essentially what their tax situation looks like, and how do we bring that information to bear on their portfolio. So while there's always going to be some debate about the topics that Nick mentioned tonight, what is always true is that we should do our very best to try to put together a portfolio that works best for our clients. And if you're working with another advisor, that's a litmus test. You want to know that that person that you're working with is looking at things through the light of the information, the data that we have out there, talking with their trusted partners, getting their perspective, internalizing that, and then doing the very best that they can to try to position you properly, given the information that we have. We do spend a lot of time, Matt and I and our partners, Barry and Joey, and some of our advisors, like Carol Uzelman, we debate what we think is going to happen, and in some cases we debate that with a lot of vigor. But at the end of the day, one thing we know is that we all care very deeply about our clients. We just want the best outcomes, and so a lot of times we do have many areas of consensus. And I know Matt's going to talk about some of those areas tonight. So, Matt.
Thank you, Chip. It is one of my greatest, I guess, joys in my career to work with folks like Chip and Barry and Joey and Carol and other advisors as we put our heads together and we really wrestle with, okay, this client has this concerns, this other client has a totally different concerns. How can we build portfolios that make sense for the various clients that we have? And we consider it to be a very high calling, and we do our very best. But thank you for those comments, and thank you again, Nick. I did have a few things I wanted to share that we have come out of a lot of discussions with partners like JP Morgan as well as others, and just some internal discussions we've had. One idea that we wanted to share is that right now your portfolio may be overweight toward growth, may be overweight toward large core, and we're talking mainly due to these Magnificent Seven or these companies that have really pushed the indexes up, the Nvidias of the world, the Apples, the Facebook or Meta. These companies have really pushed the market higher, and so rebalancing back towards value and also rebalancing back towards dividends can be a wise move. So we wanted to mention that as an idea for you. Something interesting, if you go back all the way to 1927, you can look at dividend paying stocks, and you can see that compared to the overall market, dividend paying stocks have actually in some cases been lower risk than the overall market. So it depends on the type of dividends, but sometimes the highest yielding stocks can be more volatile. But the middle area or even the low dividend payers can be a ballast to a portfolio. They can bring risk down, and then also just tracking all the way back to 1927, they've kept up with the overall market. So now here in recent years, certainly we've seen dividend payers lag non-dividend payers, but we think going back to one of the slides that Nick shared, when you get up over about 5% on the 2-year Treasury, you start seeing that dividend stocks have done better than their non-dividend paying counterparts. So again, all of this is historical. We can't guarantee the future, but looking at history, dividends may be a good place to be at this time. And then idea number 2, I just wanted to share the developed international market. Not talking about emerging market, but more developed companies, more financially strong companies. Some in Europe, some other places. These companies get a lot of their revenue from the United States. They get a lot of their revenue from other parts of the world. It used to be that European companies got a lot of the revenue from Europe, but now it seems like times have changed, and a lot of the revenue is coming from elsewhere. So these can be trading, just depending on the company. These can be trading at significant discounts to their U.S. or American counterparts. So adding some portions of your portfolio to developed international can be wise. Europe seems to be in a little bit of a sweet spot or potentially Goldilocks territory. This is according to Morningstar Equity Research strategist Michael Field, who wrote recently, it's weak enough that the central bank should not be concerned about overheating by cutting rates. At the same time, still has enough life left in it. Speaking of the European economy, judging by recent data points showing upticks in mortgage lending and service industry activity, meaning that stimulus here in the form of rate cuts could effectively kindle economic growth. So a little bit of different environment over there, but something to consider with the help of your financial advisor. And then number 3, quickly, I'll share one more idea. Nick alluded to this. CDs are paying, in some cases north of 5%. The short-term CDs, which is very attractive and it's very easy to go in there and get you a great rate on a FDIC insured CD. With that said, if rates come down, you're going to be subject to interest rate risk, which is where you're trying to reinvest those dollars at a lower interest rate. And a lot of times when rates come down, other areas of the bond market, other areas of the fixed income market have already started to move up. So you may miss your opportunity there. Again, strategically and with the help of your financial advisor, looking at investment grade corporates on the short end of the curve, as Nick said, or again, short end of the curve, core bonds, just as an alternative to CDs. You can get a little bit more yield. And also, if rates start to come down, often you can see a nice jump in price appreciation. So, just 3 ideas I thought we'd share this evening. There's others, but those are 3 ideas that you can call us about if you have more questions. If you'd like to talk further, we're happy to talk with you anytime. And so let's look and see if we have any questions out here. Let me just dive into our Q&A.
Yeah, there was one from Raymond. In this climate, what is a recommended strategy for retirees in the 75 to 85 age group? I'll let you gentlemen handle that one.
Oh yeah, great question. Absolutely. Thank you for that question. And so, in this environment, certainly, and I apologize, I didn't catch the very first part of that question. If you don't mind reading it one more time, Nick.
Yeah, it was in this climate, what is the recommended strategy for retirees in the 75 to 85 age group?
Yes, absolutely. So these are folks who are just a little bit maybe more risk adverse, right? As they've already gone through some portion of their retirement potentially. And so a lot of different things that we could propose, but we typically don't start with an aggressive portfolio for somebody like that. And in our models, we do make adjustments. So let's say the client has sat down with us and we've determined that they are comfortable with a risk score that is conservative. Even in that conservative model, we are and have made adjustments given the current environment to try to de-risk some, and we will continue to do that. So that's the first part of the answer. Not that we would take somebody who's conservative and take them all the way to aggressive or take them all the way to cash, but we would make small changes for you. But in addition to that, we've already talked about short end of the curve, CDs and bonds. What else would you add?
I think the only other thing that I would add is that one of the common mistakes that we'll see from time to time is that folks feel like when they reach a certain age, they should have no stock market exposure. And the reality is, if you're 75, it is possible you've got another 20 years ahead of you that you need to try to combat inflation. And so, some of our clients right now are in their mid-90s, and equities have been part of their portfolio from the very beginning and still are today. So while we do think it's important to mitigate some of that risk, when you start to see the longevity that's become prevalent in our society, we know we have to have a good, thoughtful, balanced portfolio for our clients. So that's the only other thing I would add.
And I'm looking here. I don't see any other questions from our audience, but I did have one other question here that I wanted to, as I was listening to you talk, Nick, I was thinking about and I'll pull it up here because I think it's alluded to here. Just as you were going through the conversation about the debt, right, and the fact that we are spending over 25% of our budget in 2024 is borrowing, right? Is covered by borrowing, and so I get a lot of times questions from clients about how long is that sustainable? And I know JP Morgan has talked about this. Dr. Kelly has talked about it. We can't, of course, predict a recession, but do we have any thoughts on could this be recessionary at some point? And then secondly, is it sustainable? I know, of course, you've already alluded to the concept of we've got to get rates back down so that the national debt can be serviced. But is there a world in which we could just continue to borrow and continue to borrow and continue to borrow and this go on for decades?
For sure. Yeah. I'll give you an example. Well, there's four ways, right, which we can get our debt down. And this happened after World War II, and it was a combination of a lot of things. Obviously, we had a huge industrial revolution coming out of that, and family creation, and a lot of economic growth, some decent policies that helped. But you can grow your way out of it, right? Which means we probably have to lessen government regulation and allow the economy just to grow from a private standpoint. I don't know if that's going to happen. Um, you can spend your way out of it, not by spending more, but by cutting spending. And again, I don't see either political party that has any fiscal sanity or any willingness to cut spending. So I don't know if we're going to do that. You can tax your way out of it, which I do think over the next, well, between now and 2030, I think there's going to be some policies set in place. I don't know if that's necessarily income taxes, but, different ways to look at payroll taxes, different ways that we look at Social Security, some means testing, more means testing for Medicare and Social Security. Some muni strategies, things of that nature may be good for those in a higher tax bracket. Or, and this is what I thought they would try to do, you can inflate your way out of it. You can let, and the Fed won't say this, but you can let inflation run hot. And as long as the bond market doesn't backfire, meaning interest rates go to the moon, if you can keep interest rates relatively low or stable, and inflation runs a little bit higher than that, then you can slowly just inflate away this debt over time. And I think a combination of a few of these is going to be the way that they try to do it. Now, the problem with inflating it away, you got to control yields, and you got to control rates. And this is something that the UK just dealt with a little while ago. They call it the Liz Truss rule, where she was in for a couple of months a few years ago as the prime minister, and she basically ran on, we are going to spend a ton of money for Britain, and yet we're gonna cut taxes. And that was like applauded, like, heck yeah, all these new policies, and yet you're going to cut our taxes at the same time. Like, what could go wrong? And what went wrong was the bond market. And the bond market said, all right, if you want to do that, well, what do you think about 6% rates on your debt? And they were like, yeah, that's fine, we can deal with it. We're doing some really good things here. And then the bond market was like, well, what about 7% rates? What about 8% rates? So eventually they had to kind of get off this agenda of spending a ton and lowering taxes. And they had to kind of meet on the middle. Like, we can't just spend and not tax. We have to kind of do both. And so the bond market brought back fiscal sanity to the United Kingdom. And I think we could see that in this country eventually if our politicians refuse to make any tough decisions. But bottom line is, unless the bond market really revolts, we can continue to spend and spend and spend as long as our interest rates stay under control. But again, it's tough to keep interest rates down as low as they are when we're just racking up debt and debt and debt. I think investors are going to demand a higher return to take on U.S. government debt if it's, completely out of control. And that will make us get back to fiscal sanity. The other thing that I just heard is there's a possibility, the Fed just kind of in conjunction with the Treasury Department just kind of hits a magic button and they just kind of make this disappear. And that's not like literally disappear. They just, obviously foreign buyers would have to be, compensated for whatever they have. But as long as it's all U.S. debt owned, or a lot of it, they can just kind of write it off to a certain degree. And you may see a combination of that. So I wouldn't be too worried about the debt, us defaulting or anything like that. Like, who is going to take over the reserve currency of the world? Is it going to be Europe? Like, absolutely not. Is it going to be the Chinese? Like, nobody trusts their currency. Middle East, Russia, like, no, we're the cleanest shirt in the dirty laundry. Is Bitcoin going to do it? Like, I don't think so. Right now, Bitcoin, you can invest in it, have at it, but it's also used to facilitate drug deals and trafficking of human beings. So if you think that's going to take over as the reserve currency, no way. So And sorry to be so harsh and
Yeah.
blunt, but that's
Well,
just the matter.
I actually like some of your ideas. When are you going to run for president? I'll throw my hat in the ring there.
Way too many skeletons in the closet. There's no way. Unfortunately, our political system, I think I'd love to see our CEO, Jamie Dimon. I think he's very moderate. I think he's got good ideas that appeal to both sides. He'd make a great president, and yet he has so far like zero interest in doing so because, again, I just don't think he wants to put his family through what you have to go through in order to aspire to that. But
you heard it first here, folks, right here on this webinar. There's insider information. No.
there was one last question. This AI craze has caused the market to move higher based on performance of just a few companies. Does that mean there are a lot of other companies that are still trading at reasonable prices? If so, can you provide any suggestions on ways to invest in those? My answer to that, you might have a different one, would be yes. A couple things. So, you want to be in a portfolio that maybe is not just all tech and all AI. Maybe you have a kind of a growth portfolio that can invest in industrials and materials. So I'll give you just a little example. Coming into 2023, we thought tech was way overpriced, and it was, and it struggled in 2023. I'm sorry, in 2022. So we got out of the tech companies that were making the technology, and we moved into the industrial companies that were utilizing the technology. So like we moved away from a company that was making this great GPS technology for farming, and we bought John Deere in like a large cap growth tech portfolio. Why? Because John Deere was the one company utilizing this new See and Spray technology, which literally allows a farmer, or, well, if they've got the technology on their tractor, to determine whether to spray a weed or whether to fertilize a crop all at the same time. And it cut the process of being a farmer and doing that sort of thing, in half. And so I think you want to be invested in portfolios or with portfolio managers that have the ability to pivot and be active, and not just invest in only high octane tech companies that will do well as long as the momentum's there. But if it's not, like we saw in 2022, you can get hit pretty bad. But yeah, there are now 3 companies that could become the next Microsoft. They're not trading on the public market now, but they each got about $200 million in funding. I don't know if they'll be on the public market or not, but like you want a manager that can dip down and, again, find the NVIDIAs when they're small, and find the next Amazon when it's a small cap company. Not that Amazon's not a good investment now, but it's not going to go up another 15,000%, I don't think. Maybe it will. Who knows? So, be invested with managers that can dip down and find some of these small and mid cap companies that will be the next NVIDIA, Microsofts, Apple, Amazons. And again, I think you want to invest in active management. I'm a big believer in that.
All right. Well, it looks like we're out of time. Thank you so much. And thank you, audience, for joining us this evening. I'm going to throw some slides back up to make my compliance officers happy. And we'll make sure I share these with you. But again, certainly, if you have any questions, or if you have any desire to sit down and talk, we don't charge for that first meeting. We always want to be helpful. If you just want to talk by phone, you want to sit down, whatever we can do to help you. We realize this is complicated, and certainly it's good to bounce ideas off of someone else that might be a little bit outside of your current situation. So that's what we're here for. I'll make sure I'm able to show you these disclosures. And Chip, do you have anything you'd like to add before we wrap up this evening?
Oh, Matt, I appreciate the time, and thank you again, Nick, for joining us.
All right. Yeah, absolutely. And I'll just knock through these slides real quick for you. But again, reach out if we can be of help. And thank you for your attendance this evening. We will be sharing a replay, so be looking for that. And again, thank you. Have a great evening, everyone.
Thanks all. Take care.